On the morning of April 1st, 2026, the routine financial tasks of millions of Indians appeared unchanged. Citizens checked bank balances, paid for tea via UPI, and withdrew cash from ATMs, following their usual patterns. Yet, beneath these interactions, the underlying architecture of the economy was overhauled and replaced with a new legal and digital framework. The previous system was based on analog assumptions. It placed bureaucrat barriers in front of individuals trying to manage debt, while often failing to accurately track the flow of modern digital wealth. To address this, the government implemented a series of synchronized changes. The objective was to remove specific barriers to individual wealth building while establishing a broader digital oversight system. For over 60 years, the 1961 Income Tax Act served as the anchor of the analog era. It was a complex document that forced taxpayers to navigate overlapping periods. Income earned in a financial year was calculated and filed during a separate assessment year, creating unnecessary confusion for routine filers. Banking regulations added further friction. Borrowers with floating-rate loans were often charged penalties of 2 to 4% simply for attempting to pay off their debt ahead of schedule. These rules effectively penalized consumers who were attempting to accelerate their financial progress. The April 1 reforms were designed to eliminate these legacy manual systems, replacing them with a framework built on digital visibility. This shift began with the implementation of the Income Tax Act 2025. The legislation has been consolidated. Over 800 scattered sections were reduced to 536. This removed the overlapping labels of the past. Under the single tax year, the period you earn is now the period you file. While the tax code was being simplified, the Reserve Bank of India addressed the cost of household debt. The RBI mandated the removal of prepayment and foreclosure penalties for individual borrowers on all floating-rate loans. For an individual with a 40 lakh rupee home loan, injecting a 5 lakh bonus into the principal no longer triggers a bank fine. That specific penalty is now zero. This change makes personal capital more mobile, allowing citizens to reduce their debt without being charged by their lending institutions for doing so. However, this increased mobility is paired with a significant increase in financial reporting and transparency. The RBI has implemented a mandatory security protocol for digital payments, requiring dynamic two-factor authentication. Standard PINs and OTPs are no longer sufficient. Transactions now require dynamic factors, such as biometrics or device-specific tokens, to mitigate risks from phishing and fraud. This digitized environment feeds a reporting system known as the Statement of Financial Transactions. Credit card spending that exceeds 10 lakh rupees in a single year is now automatically flagged to the Income Tax Department. Simultaneously, the reporting cycle for borrower data has been cut in half. Banks must now update credit bureaus like CIBIL every 7 days, rather than every 15. Loopholes in corporate spending have also been addressed. Personal expenses charged to company-issued cards are now tracked and taxed as perquisites. The focus has shifted from monitoring daily cash limits to a system that updates a taxpayer's macro-financial identity every week. This creates an economy where efficiency and oversight are linked. Citizens can manage debt more freely and navigate a simplified tax code while operating within a more secure digital environment. This system functions most effectively when an individual's declared income is consistent with their digital spending footprint. Significant discrepancies between reported earnings and actual expenditures will be identified by the algorithmic tracking of the new framework. Compliance is no longer just a matter of filing, it is about ensuring that your financial data is aligned with your lifestyle. The rules effective from April 1, 2026 represent an administrative shift in how the Indian rupee is tracked, from the moment it is earned to the moment it is spent. This framework provides taxpayers with tools to build wealth more efficiently, provided they operate within this high-visibility environment. Thank you for watching Tax TV English. Subscribe to stay informed on the evolving rules of the Indian economy. We will see you in the next breakdown.